The Federal Reserve has built their own forecasting tool to predict economic downturns. This mechanism calculates how likely it is that America will enter a recession during the upcoming 12 months, and recently it flashed a warning sign that appears very rarely in economic history. What this indicator is revealing suggests that we're approaching a pivotal moment for the entire U.S. economy. Here's what makes this particularly confusing at first glance. When you examine what the model actually shows, the recession odds appear to be dropping, not climbing. That seems bizarre given everything else we're witnessing in the economic data. Consider what's been happening with employment figures lately. Month after month, the government has released job statistics that look increasingly worrying. Take the ADP employment tracker as one example. This report measures hiring activity in America's private companies, and for the first time since COVID-19 disrupted everything, the number went negative. Private employers shed more workers than they brought on board, representing a deeply troubling shift in the employment landscape. Then there's the official payroll count from the government. These figures reveal that businesses added fewer new positions than at any point since the pandemic paralyzed the economy. When analysts compare this pace of job creation to historical patterns, they find eerie similarities to the periods immediately before two catastrophic events: the housing market collapse of 2008 and the dot-com bust recession of 2001. Those weren't minor economic hiccups. They were full-blown crises that devastated millions of families. Beyond just weak hiring numbers, there's another alarming trend developing. The percentage of Americans who want jobs but can't find them has jumped almost 1 full point higher over roughly 18 months. Outside of recognized recessions, this simply doesn't happen in the data. When economists scan through decades of unemployment statistics, they find that such pronounced increases in joblessness exclusively occur when the economy is genuinely contracting. Even Jerome Powell, who leads the Federal Reserve, has publicly acknowledged that weakening employment represents a legitimate threat to economic health. For years, the Fed concentrated almost exclusively on bringing down inflation that had spiraled out of control. Now Powell and his colleagues are shifting their worried gaze toward the job market instead. This change in priorities tells you how seriously they're taking the employment deterioration. So we're faced with this puzzling contradiction. Real-world employment data screams recession. The Fed chairman admits the risks are genuine, yet the Fed's own predictive model suggests danger is actually receding. To make sense of this paradox, we need to dig into how their forecasting mechanism actually operates. The foundation of their model relies on something called the yield curve. This has become somewhat famous in financial circles because of its impressive history of predicting economic troubles before they arrive. Essentially, the yield curve examines the difference between what the government pays to borrow money for short periods versus long periods. Normally, lenders demand higher compensation for tying up their cash for many years rather than just a few months. This creates an upward slope when you graph these interest rates. However, sometimes this relationship inverts completely. Short-term borrowing costs exceed long-term costs, creating a downward slope that economists view as deeply unnatural. This typically happens when the Federal Reserve has aggressively raised rates to cool down the economy, pushing short-term costs sky high while long-term rates remain anchored by expectations that the economy will soon weaken. When this inversion occurs, it signals that money isn't flowing freely through the financial system anymore. Credit is becoming scarce and expensive. The Fed took these yield curve dynamics and built a sophisticated statistical model around them. This model outputs a specific percentage chance that recession will strike within the next year. When that percentage climbs high, it means the financial plumbing has gotten clogged to a degree that historically triggers economic contractions. The model's track record has been genuinely impressive across multiple decades. On the other hand, when the percentage sits low, it indicates that money is flowing abundantly through the system. This liquidity abundance has historically only appeared during stable economic times, or even during boom periods when growth accelerates rapidly. There's a recurring pattern that plays out repeatedly throughout economic history. The Fed gets concerned about inflation or overheating, so they jack up interest rates to cool things down. Credit becomes harder to obtain and more expensive. Businesses and consumers pull back on spending and investment. Eventually, this slowdown becomes severe enough that the economy tips into recession. Once the damage becomes apparent through job losses and business failures, the Fed reverses course. They slash interest rates back down and flood the system with liquidity again. This medicine gradually takes effect, stabilizing the economy and eventually launching a new expansion phase. We've watched this cycle repeat itself over and over. Here's what's genuinely strange about our current moment. The model surged to elevated levels throughout 2023 and into 2024, reaching thresholds that previously would have meant recession was virtually inevitable. Yet no official recession ever materialized according to the organization that makes such declarations. Despite those warning signals, the economy never formally entered contraction territory. But now, the model is retreating from those high levels, following the exact pattern we normally observe after recessions end and recovery begins. Based on historical behavior, this declining probability should indicate we're moving into calmer economic waters. However, there's good reason to be skeptical about interpreting this signal the traditional way. After all, the model cried wolf about recession that never officially arrived. Maybe something fundamental has changed about how the economy responds to tight financial conditions. Or perhaps the recession is merely postponed rather than canceled. When we layer in unemployment data, the picture becomes much clearer. Throughout history, whenever liquidity dried up in the financial system, unemployment started climbing shortly afterward. These episodes of rising joblessness invariably corresponded with recessions that economists later confirmed. Our current experience actually follows this established script quite closely. The liquidity squeeze of 2023 and 2024 absolutely did trigger rising unemployment, exactly as the historical relationship would predict. We watched joblessness climb from comfortable levels to concerning levels in a relatively short span. As mentioned earlier, numerous indicators suggest we're teetering right on the edge of recession territory. Just because no official declaration has been made doesn't mean the labor market hasn't experienced recession-like conditions. Here's where it gets really interesting. If you take the Fed's recession probability model and shift it forward by roughly 12 months, then compare it to unemployment, something remarkable emerges. Every peak in the model lines up almost perfectly with subsequent peaks in joblessness. The correlation is striking once you apply this time adjustment. What this means is that tightening liquidity predicts rising unemployment about a year down the road. Companies react to credit restrictions by slowing their hiring, eliminating positions, and generally becoming more cautious. Conversely, when liquidity loosens up again, unemployment tends to fall over the following year as businesses regain confidence and access to affordable capital. Based on this historical relationship, the Fed's model is essentially broadcasting that unemployment has hit or is approaching its ceiling for this cycle. We've been making this argument repeatedly over recent months. Despite how grim conditions might appear right now, we could witness at least temporary improvement as financial conditions continue normalizing. Easing credit should theoretically translate into stabilizing or even moderately improving employment figures in the quarters ahead. But here's the crucial caveat that can't be ignored. The model still reads around 30% recession probability. That remains extraordinarily elevated by any reasonable standard. After previous genuine recessions, this probability collapsed down to nearly zero as robust recovery took hold. Following the 2001 tech bust and the 2008 financial catastrophe, the reading dropped into single digits once expansion was clearly underway. So while conditions have improved from their most restrictive point, they're nowhere near what you'd call truly accommodative. We're stuck in this uncomfortable middle zone where things aren't getting dramatically worse, but also aren't getting significantly better. We also have concrete evidence from the banking sector that confirms this assessment. The Federal Reserve regularly surveys bank lending officers, asking whether they're making it harder or easier for companies to borrow money. This survey has its own impressive track record of anticipating economic downturns. Banks tighten their lending criteria in the months leading up to recessions as they sense trouble brewing. Before the 1990 downturn, before the 2001 tech crash, and before the 2008 financial meltdown, banks were making it tougher to get loans. The pattern holds consistently across cycles. After those recessions ended, banks swung hard in the opposite direction, loosening standards dramatically. The survey would plunge below zero, meaning more banks were easing than tightening. This credit expansion helped fuel the subsequent recovery. When we again apply a forward time shift to this bank lending data and overlay it with unemployment, the lines track each other remarkably closely. Banking sector restrictiveness serves as a leading indicator for labor market health about 12 months out. When banks clamp down on lending, companies can't expand their operations and unemployment rises. When banks open the credit spigots, businesses can invest in growth and hiring accelerates. Right now, the survey shows lending standards remain quite elevated. We're not seeing any meaningful movement toward the kind of dramatic loosening that would signal banks believe strong expansion is coming. The lending environment stays restrictive, which naturally constrains how much companies can invest in new equipment, facilities, and workers. Given all this evidence, our assessment is that unemployment probably won't surge dramatically higher in the near term. But we also don't anticipate an extended boom period where joblessness plummets rapidly. The data simply doesn't support that rosy scenario given where bank lending standards currently sit. What seems most probable is continued muddling through with modest growth and persistent but manageable labor market weakness. The economy will likely limp along rather than sprint forward. Interestingly enough, equity markets have performed exceptionally well despite all these recession concerns and employment weakness. Stocks have delivered impressive gains for investors willing to maintain long positions. Thanks for watching. Make sure to subscribe so you don't miss future updates. See you.